last week, Pravin Gordon spoke to the nation and released what was generally termed in the media quite a balanced, quite a practical, quite a pragmatic budget. But we're really going to look to our panel members tonight to not only unpack what was said, but more what wasn't, and the impact on the South African economy.
Thanks, Kevin. I think some of the commentary that I saw in the press also had words like muddle through and lackluster budget as well. So by and large, if you looked at last week's budget, first of all, let's look at the scenario. So the growth outlook, very poor. I mean, below 2% at 1.9 for last year, that's dismal by any measure, especially when the developed world is growing at faster rates and at a lower risk-adjusted basis. So on that basis, I think, last year's growth certainly completely dismal. And the outlook for this year, he has moderated. So he's come in more or less in line with where the market's seeing it at around 2.6, 2.7%. And I must say that's somewhat realistic. I think last year, throughout the year, in the initial budget, in the medium-term budget, they came out and they successively revised their outlook for growth lower. And I kept on saying it's a bit too optimistic. That being said, is 2.6 or 2.7 realistic at this point in time? Probably, but with the main caveat being that the first half of this year is probably going to be exceptionally difficult. We've got a whole host of issues that haven't been solved by the budget. They're not intended to be solved by the budget, and those are pervasive. They are labor unrest, for example, rigidities in the labor market, the lost production that we never get back despite the much weaker rand that obviously politicians promised people that a weaker rand would certainly result in better growth. It doesn't. We can unpack why. So the first half likely to be quite difficult. The second half, again, on the understanding or on the basis that the global economy tends to rebound, tends to have a good uptick, we should get some of the trickle-down effect come through. So I would foresee a better second half of the year than the first half of the year. In terms of the budget, just very quickly looking at inflation. We know the inflation or the prognosis for inflation remains remarkably poor. The key risks there remaining the weaker rand, which is why the move on the next SARB MPC really does become quite rand dependent. If the rand's anywhere around 11 and maybe a little bit lower, they'll probably hold back. They won't hike rates again. If, however, it accelerates and we're looking at 11.30s and beyond, potentially another rate hike on the cards. And we've penciled in another 50 basis points for this year, and then probably a flatter profile than most of what the market's pricing in. The market has priced in a very aggressive hiking cycle. Over and above that, if we look at what wasn't in the speech, first of all, the rhetoric around aligning this to the National Development Plan, that's all well and good, but they're scant on the detail, the much needed infrastructure spend that needs to come through. It's there, but it's hazy. So I think, and I mean, the other panelists will probably unpack this in a bit of detail and in the discussion. The budget, nothing in there that will really, in my view, spur the ratings agencies to downgrade us, but similarly, nothing in there that will spur the ratings agencies to change their view to the positive. And just having a quick look at that, S&P is probably the most bearish right now, so they've got us on the lower notch, and they've got us on a negative outlook. Then we've got Fitch, that's on the same level as S&P, but on a stable outlook, and then Moody's, that's a notch above the two. So if you see headlines and you say, ratings downgrade imminent, in all likelihood, it's probably going to be Moody's coming in line with the others, but the budget, again, lackluster, probably very benign, and that's really the context we find ourselves in. The deficits aren't going anywhere this year, and unfortunately, that's the key risk. It's why we will remain amongst the more fragile emerging market economies out there. If risk appetite on emerging markets stays poor, unfortunately, we're likely to bear the brunt of that.
I think there are a couple of things that jump out at me. First, we had the rate hike, and the rate hike was essentially driven by what happened in Turkey the day before the SARB met. And that's always worrying when you suddenly have policymakers reacting short term to something that's happening, to world events that are happening around them. And I think there was a lot of concern that this budget was going to be populist, it would be driven ahead of the elections. It was going to say it will make all the right noises, it would give these really big targets, yes, we'll make them, the development plan, etc. And I think what really came through, and I don't think Pravin Gordon's necessarily received the kudos he has for it, he gave a very solid budget. We sit in the situation, and obviously a lot of it's driven by what we see in the media and that kind of thing. But we sit in a situation where guys are fighting for the headlines, political parties are fighting for the headlines, and they want to be able to make these big promises. And to Praveen Gordon's credit, he's just managed expectations really well. I think he's a little bit too optimistic in terms of growth, but I think it's realistic enough given what is happening in the world at the moment.
This is how it was sold. Budget focuses on growth. This was in the inserts in the newspapers and the media, etc. So I'm saying it was sold to me as a growth budget. So then I want to look in the budget to see what was done for growth. Now, how do you get growth going? Well, growth depends on investment. It says that in the budget. The speech was magnificent. So you then look at the details of the actual tax proposals to see whether what was said in the speech is backed up in the actual proposals. And this is where I thought it fell short. Because to get growth, you need investment. And to fund investment, you need savings, capital formation. And if I were to say what the budget was, it was a welfare budget. If it described to me the budget focuses on welfare, I'd say, full marks, that's exactly what it was. But it also stabilized things because we're clawing back the deficits. Now, we've spent our way into what's called the Fragile Five. We've striked our way into the Fragile Five, and we're sitting in a sort of precarious situation. One of the consequences has been a weak rand, as already mentioned. And this budget, I think, if the projections stay there, the expenditure ceiling, they are serious about that and they stick with this expenditure ceiling, etc., we will claw our way out of the Fragile Five. We'll claw our way out of the risk of a rating downgrade. And so from a stabilization point of view, I thought this was okay. Only okay, but it was okay. But as a growth budget, I would have liked to have seen something on the tax relief on saving and investment. That's critical because although the minister says we do not have a savings culture, I want to spit blood every time I hear that because he's blaming us for not doing something, in other words, savings, something that he has made unviable. Just think of it. If you borrow money, you can get a reduction in your tax liability. If you save money and earn interest, you increase your tax liability. Now tell me, does the tax policy favor the borrower or the saver? Okay, just as a curiosity. So I would need to see that imbalance shifted. Capital gains tax, dreadful when you're trying to build capital, when you're capital deficient and have got a huge unemployment problem. Capital gains tax, transfer duty on houses, the pension withdrawal benefits, which was the only significant move that I saw, but still a very cruel tax when you're actually retiring and you don't have enough, and yeah, you have the tax man, grabbing at it. Basically, these taxes need to be scrapped if we want to build the quantum of capital that we need, because we've got a fundamental macroeconomic mismatch. We are investing at a rate of about 19% in the GDP and saving at around 14, 15%. And that's created a mismatch, right, which is one of the reasons we sit in deficit territory and an unstable macro environment. But the problem is to get an investment rate of 19% will sustain a growth rate of 2 to 3%. And to get a growth rate of 5, 6, 7%, you need an investment rate of closer to 30% of GDP. And that's in the National Development Plan, but the connection made with savings is not there. And so I want to see how they take the money means that you need to give relief to saving and investing. And then how they allocate it. At the moment, they're doing, the budget is trying to deal with inequality, it's trying to deal with poverty. So poverty is poverty alleviation. You give grants, you give subsidies, you give free houses, that kind of thing. That gives poverty alleviation. It's paid for by what's called a progressive tax system. In other words, if you don't earn a lot, you don't pay. If you earn a lot, you do pay through the nose. So that helps to reduce inequality by reducing people's incomes. And then so when we say we're an unequal society on a gross basis, it's huge. But on a net basis, the gap is actually closed considerably after the tax efforts, etc. But what we need, we've exhausted that. We now need to actually shift from poverty alleviation, which is shifting resources to consumption. We now need to shift to poverty reduction, which is job creation. It's shifting resources to investment. Very, very different economically, that distinction, and you must understand that. The other is to actually say, how do you deal with inequality? We've just, through the last 20 years, dealt with inequality by reducing people's incomes. We now need to start shifting, and that's run its course. We now need to start again, through job creation, by lifting people's incomes at the lower end. All right, so they talk about that, inclusive growth and that sort of thing, and that's great, but we're not doing it. The connection between what we say and what we're doing is absent in this budget. So as a growth budget, it failed again. As a stabilization budget, a welfare budget, well, that's exactly what it was. But the whole issue, creating jobs and all that, we are not even remotely there. We talk the talk about small business and savings and investment, but there is no doing any walk in this particular budget or previous budgets or whatever the case is, and that's what frustrates me. You need to actually walk the talk. We've got the triple problem of poverty, inequality, and unemployment, right, which I think is an unemployment problem from which is a poverty and inequality consequence. Very different, but we've focused on the poverty and inequality, done nothing about the unemployment, and we're making the triple mistake of striking our way into the fragile five, all right, so strikes, regulation, which cuts out your small business because they require economies of scale to be compliant, and the taxes on saving and investment. So those three mistakes are what we're not resolving.
Position. A couple of things. One is that talking the talk. So the speech was very well presented, and it's sold very well. You've got the fancy, glossy pamphlet. You've got the slap on the back. We've done well over the last 5 years. And yes, in some respects, we have done well. So we've alleviated all the funds transfer from the wealthy to the poor. We've done well on that front. But the problem is the sustainability around a budget where greater than 50%, around 55% of the budget is orientated towards social spend. That's not sustainable. It's not the kind of economy that builds capacity. If you look at stuff like gross fixed capital formation or greenfields, foreign direct investments that's happening here, not foreigners coming in and buying an existing company that's listed on our board. That's not happening. We're not getting the new projects coming on stream. Okay, you've got a couple. So if you look in the automotive sector, there's a nice substantial investment from Mercedes-Benz. But even on that particular basis, we're not optimizing. And foreign capital is fickle. The type of foreign capital that we attract is fickle. We're attracting portfolio flows. We're not attracting direct investment. To give you a sense of the portfolio flows, in January alone, we had foreign portfolio outflows of around, and don't quote me on the number, but it's pretty close, of around 26 billion worth of an outflow. That's enough to offset all of the gains that we made during last year. So foreign capital is fickle. I'll give you a good anecdote, a good example. Cast your mind back to the xenophobic attacks 2-3 years ago. Got a phone call from a fund manager in London saying to myself and a colleague, "Geez, are you guys okay? Are you okay? What's happening in South Africa?" And we were walking here in Sandton. We said, no, we're just going to get a bite to eat. What's the story? And we said, but people are burning. But that's what they see, and then they hit a very big sell button that is indiscriminate. And South Africa is tiny in their entire context. I mean, it's literally, if it's 1% of their portfolios, that's big. And so when they sell, the order is not, can you massage the price, can you get me out at a reasonable price? He says, sell at any price, get me out. That's why the rand capitulates and moves. It weakens a lot more sharply than it strengthens. That's the reason why. That's the psychology behind it.
Yeah, just to emphasize what the budget does for you. This is the people's budget. Okay. What is it? It does industry support. 10.3 billion will go to manufacturing incentives. Now, what incentives are is takes money out of one set of taxpayers' pockets and transfers it into another set of taxpayers, usually, out of the teachers' and nurses' pockets and that kind of thing, and into their friends' pockets, who's starting businesses and that sort of thing. It goes to job creation. Now, the next 5 years, government intends to create 6 million jobs through expanded public works program. 6 million jobs is actually just job opportunities. They're not jobs. Now, what is a job opportunity? A job opportunity is like being able to smell a plate of food but not eat it. Okay, that's what it is. Okay? And that sort of thing. It says fighting corruption. I think the actual corruption fighting team is currently in retreat, devising their plans and strategy at Nkandla right now. And, etc. But there's 6 things here. But the point is that words, they're lovely words. They really are. They're encouraging, they're hopeful words. Do you build debt or do you build savings? Because if you're building debt, you then become trapped in jobs you hate, ultimately. What should be happening is that you should be building savings so that when you've gained some experience in the corporate world, etc., you then said, at some stage, I've done enough of the corporate thing, shift out, set up a business, etc. What we're saying is, as adults, we'll cling to jobs we hate because we've got debt, we've got the next car payments, all the rest of it, until the teenagers to say, sorry about that, we don't have jobs, create your own, okay, without capital experience or anything like that. And I think we need to actually build up a proper job creating model. All right. When I say we're talking about the budget is not supporting growth, that doesn't mean there won't be growth. Okay, the budget hasn't supported growth for the last 30 years, right? But we've had cycles, and these things go in cycles. We are reaching the point of what I call maximum pessimism in the economy, and that will be reached before the middle of the year, right? By the end of the year, we're already in an upward cycle. Okay, so I don't know how to describe this simply. You've got weak rand filtering into higher producer inflation, higher consumer inflation. That's putting Jill Marcus in a bad mood, so she hikes interest rates. It takes money out of our pocket, which leads us to lower demand. It subdues economic growth, and because of that, we import less, and that takes pressure off the balance of payments, and that pressure off the balance of payments leads to a rand that starts to strengthen, and that stronger rand leads to lower producer inflation, lower consumer inflation, which puts Jill Marcus into a good mood, and she cuts rate, we go shopping, economic growth starts to pick up. Now, the point about that is that by the middle of the year, the bottom of the cycle is by the middle of the year, you'll start to see the trade balance improve. The rand probably reaches its maximum weakness. By that stage, we're weak enough to start sending a multi-year strong strengthening of the currency. By early next year, you were already on the threshold of a downward cycle on interest rates, etc., on that thing. So that's the first thing. The second thing is, although we've been critical of the budget, do you remember last year how the US did their budget? This is the first world, okay? And the debt ceiling, that shambles that you saw, all right? And the government shut down for a period because this one couldn't agree with that. And then Provident Gordon delivers the medium-term framework followed by the budget, etc. It is an outstanding process, almost unparalleled in the world, just in terms of the quality of how we actually plan and manage those finances, right? So be that in mind, is that we it's not all bad, okay? It's just that when we sit and criticize, we know it could be better. And that's where we get disappointed, is it could have actually been better, right, if we didn't have the corruption and maladministration and that sort of thing. How much further could we have been?
Chris, I think to the madam's point, we
So
don't
we're
want
not
to sell you
completely
Prozac.
swamped.
No, I'm not trying to swamp. I'm just saying there are enormous benefits. The fact is that this budget takes us out of the fragile five. That's the big strength of it, is that within 2 or 3 years, if the projections work, right? We're no longer part of the fragile five. We're no longer getting credit rating downgrades. We're out of that risk. That's the strength. And I think if the intentions in some of the measures that were said we're up for discussion start to come to fruition, the space for small business gets opened, we might start to actually think in terms of the saving. And next year's budget, we might actually call it a growth budget. Right? And that's where my hope is, yes.
Thanks for the hope for the future.